Hello, my name is Andy Barkate, and I'm the publisher and the editor of the Think to Retire newsletter. And thanks for listening to our short video today, which I've titled, What's in It for You? We talk a little bit about what you get and the pricing of our newsletter. So let's go ahead and get started. Okay. The whole purpose of the Think to Retire newsletter is to give you a system that you can use to help you do better financially. That's something to actually give you the methodology to do what you're doing, why you're doing it, and when to change that. Again, it's a rules-based system. We believe most investors, most individual investors, underperform or fail to perform well at all, not because they're not smart enough, not because they don't care enough. That's absolutely wrong. We think it's because most people just don't have a system to guide them, to show them what to do, when to do it. And that is what our newsletter does each and every month when they give you the allocations directly associated with your 401k, your mutual fund, your 457, your brokerage platform, anything. It's going to give you exactly what we suggest you be in based upon what the market is doing at that particular time. Again, we were trying to reduce risk. That's one of the biggest things about our newsletter. We believe if you can take the downside or a large part of the downside out of the bad years, the good years and your long-term returns will just be that much more elevated. You'll do better over the long run just by reducing a lot of the downside in those bad years. And again, you don't want to sacrifice all the growth. We believe reducing risk will also aid in that long-term growth. And the whole idea is we want to make it extremely affordable. And we talk a little bit about pricing in just a few minutes, but we don't believe you need to have the professional investment advisor, which is going to charge you a fee. We believe you can do it yourself with a little bit of help, which we are very happy to give you. And we believe, as our motto down at the bottom, we believe you can do it for yourself, but you don't have to do it by yourself. Okay. You're going to get a monthly newsletter. It's going to come the first business day of each month, and it's going to give you the allocations based upon, again, your specific 401k, your mutual funds, your 457, and your brokerage platform, where you're probably going to be using exchange-traded funds. And it'll change from time to time based upon what's happening in the market. We're trying to keep you in the stronger sectors and away from the weaker sectors, and I'll touch base on that in just a minute. Again, you get the monthly newsletter. You're also going to get a weekly market update. It comes every Monday. It's emailed right to your inbox. It's going to give you a brief description of what the market did the past week and give you some ideas about what might be causing market changes in the upcoming week. It's designed to be a short 5-minute read to just keep you updated. We do monthly webinars. They are live. All of our subscribers will be invited. And we talk a lot about the Think to Retire and the adaptive investment allocation methodology, so our subscribers can get the best out of the newsletter. We want to make sure you can understand it the best you can, so you can get the best out of the use of the newsletter for you and how you want to use our newsletter and AIA. Okay. We also do coaching calls. Now, this is on an as-needed basis. We're open to doing as many coaching calls as you'd like to have to explain how to use the newsletter best. We'll do demos. We do virtual meetings. We just talk on the phone a bit, whatever works for you the best. And again, you can call back multiple times. Every time you have a question, we want to be here to answer that question so you can get the most out of the newsletter. And again, the AI video is important to understand, as well as are the risk indicators. And we've got separate videos on that, which are in our video library. So I suggest you might go take a look at those. And again, hopefully they'll fill in a lot of the blanks. And if you have other questions, simply go on the website, request a phone call, request a demo, and we'll go through them all. Okay. Let's turn straight, guys. Okay, this talks a little bit about sector rotation and asset allocation rotation, which is really what AI is delivering to you every month. Markets have personalities, which again is just a way of saying what's working today may not work tomorrow. Certain sectors, certain asset classes may be favored today, and because of economic changes in the world and in our economy, those stronger sectors may change and rotate over time. And that's why the newsletter is given to you every month, because we want to keep giving you, we're ranking those areas. We want to give to you the stronger sectors and the stronger asset classes. And that data is taken and overlain on top of your specific 401ks, your mutual funds, 457s, and your brokerage firms platforms. So we're giving you the stronger sectors, the stronger ETFs, the stronger mutual funds, specifically designed to be used with your individual accounts, so you can actually make those transactions very easily. And again, we're trying to make it as quick and seamless as possible, so you don't have to spend a lot of time reading and analyzing. You can If you can open an email, you can go and log on to your 401k or your brokerage account. You should be able to make the changes in 10 or 15 minutes. After you get pretty good at it, you've done it a few times, probably even less. Okay. The risk indicators are a very important piece of this, and this is all done behind the scenes, but I just want to explain to you why they're so important. Markets don't always go up, as we always know, and we are trying to judge on an ongoing basis by using data, by using the metrics that are surrounding the market direction. Is it, if we're in an uptrend, what is the data telling us about that uptrend? Is it more than likely to continue? If the market's in a downtrend, we're doing the same thing. What's the likelihood of that downward trend continuing to go down? And if that downward trend goes up and that data suggests it might continue, we're going to issue an alert to get back in the market. Or if it's up and it looks like it's going to come down, we're going to issue an alert to get you back out of the market. That'll come right to your inbox, and it'll tell you again what to get out of and what to get into. It'll suggest the specific funds and specific ETFs to use. And if we're getting back in the market, the same thing applies. We'll suggest what to get out of and get back into to take advantage of what looks like might be a strong trend going up. And again, we're trying to make sure that you are just on top of it. We're doing all the heavy lifting in the background. Simply, you have to open up the emails and be able to log in your brokerage accounts and apply the changes. Okay. This is a historical return graph of using AIA in a moderate fashion. Now it says AIA moderate at the top, moderate growth. That is basically 60% of a portfolio using the AIA suggested allocations, and the other 40% in something very safe. It could be bonds, short-term bonds, money market accounts, fixed annuities, whatever that might be, but it's not in the market. Only 60% of the portfolio is tied to the market. The rest is in safer assets, that 40%. And you see the growth rates. The blue line is the AIA method. The bottom line, the gray line, is the S&P 500. Now, what this doesn't clearly show you is, it does clearly show you AIA is not perfect. It's not a get-rich-quick system. It's not something that's going to try to time the market. It's trying to reduce risk and over the long run increase your rate of return because of that risk reduction and trying to get out of the way of trouble. Now, if you can see this little dip we see right here and right here are very important. This dip is roughly about a 40% drop in the S&P 500, which happened back at the turn of the century. That was the dot-com bust, 9/11, that was all baked in there. And this dip you see here is the mortgage meltdown we had back in 2007 and 8. That was over a 50% drop in the S&P. And what we see out here is COVID. That was about roughly about a 32% drop. AIA successfully allocated and got us out of most of that downside. Didn't avoid all of it. It's not designed to try to time the market. It's designed to look at the data, and the data suggests maybe that downside trend looks like it's going to continue. It backed us out of the market. So we took a lot less of that downside than ordinarily would have happened if you just rode the market up to write it down again. We don't believe in that. Again, we got out of most of that market decline there, and the same here. And because of that, this upside return was so much greater. Now, if you look over here to the maximum drawdown, the worst period of time that the AIA moderate had when the market fell was just shy of 10%. The market at the same time was down about 55%. So you can see the volatility control is quite dramatic. And the rate of return as well. The market itself was up about just about 7% over this period of time, that roughly 20 years. And AIA was up roughly about 12%. So again, rate of return was a whole lot better, and it wasn't because the system is magic. That's not it at all. It's designed, again, if we can take the risk out, the rate of returns just end up being better over the long run. Okay. Let's talk about pricing for a little bit. Our prices are designed so everybody can afford it. We want to make sure that even the small investor that doesn't have a whole lot of money can afford to use our system to help them make better choices over the long run, which will hopefully turn them into a bigger investor over time. The prices start out at $495 a year, or you can pay it monthly, $49 a month. If you do it annually, you save a couple of months of subscription costs, and you can do the math there. Now, there's a family plan as well. As long as one person is paying the individual price, that $49 a month, another family member, extended family, parents, grandparents, children, son, daughter-in-laws, they can actually buy our service, our subscription for a reduced price, $29 a month or $295 a year. Again, we're trying to make this affordable for everybody, and you don't have to just use it per account. If one family is buying, say a family unit, the husband and wife, well, they can both use it with the same, only one subscription price. So if they're paying $49 a month, both husband and wife can use that. And again, you can use it for multiple accounts. You might have a 401k, you might have a brokerage account, you might have an IRA at another institution. You can use it for as many accounts as you want with one subscription fee. Okay, let's look at some costs over time to kind of help you compare. Now, I used the 1% management fee right here, but I believe that's probably too low, but I'm going to use it anyway in this example. Most mutual funds have management fees. They also have trading costs, which in a lot of cases will bring their overall fee well over 1%, maybe 2%, or maybe even more. And a lot of investment managers are going to charge 1%. A lot of them will charge 1.5%. A lot of them will charge 2%. And also some of the investments they will use while they're charging you that fee also have their own small fees attached to them too. So adding it all up together, probably going to be a whole lot more than 1%, but we're going to use 1% for this example. Just saying you have $250,000. And if you have more than that, you can just multiply the results here. The 1% management fee per year is $2,500. Well, the fee for Think to Retire is $495, and that's a flat fee, no matter how big your account is. Now let's add some time to it. Let's assume we have a 10-year period of time and the account grows 5%. Well, the management fees at 1% would be about $31,500. The management fees or the subscription cost for Think to Retire is just that 495 times 10. It doesn't grow as your assets grow. So again, it's just that flat fee. And just like I'll say this now, but I don't see any circumstances currently where that fee would increase. Our $495 fee would increase. I do see some circumstances that might actually have it decrease. As technology is furthered and we can actually do what we do simpler, the fee will go down. As we get more subscribers, the fee will probably go down. But again, I can't see an instance where it would go up. I guess I could change that, but right now I don't see any instance where the fee will go up. So having said that, that number on the bottom, $26,500, that's your savings. What would you do with that money? I mean, that's several really nice vacations that you could take versus your advisor. Okay, let's change this. Now let's go to 1.5%. Again, every year, the 1.5%, the investment fees on $250,000. And if you had $500,000, just double that. $3,750 per year. Same price for our newsletter, $495, period. Over a 10-year period at a 5% growth, that's $54,500 roughly versus the $4,950. That's a difference of about $49,000, almost $50,000. Again, that's money you would have saved that have been growing in your account just because of advisory fees. And we will argue with you that you say, well, gosh, my advisor may make me more money. It may make it safer. We'll argue with you that's probably not the case by looking at some of the returns that our Think to Retire and AIA process have provided over the long run. Okay. The only thing I've done here, I kept the same 1.5% management fee, which I do believe is probably on the low side overall. And I've taken the 10-year period and made it 20. Okay, everything else being the same. Over that 20-year period, 1.5% with a little bit of growth, you'll pay around $165,000 in management fees versus $995, $9,900 using AI, which is just basically that $495 times 20. It's roughly about $156,000 of difference in your pocket growing for you, or basically you can do anywhere, whatever you want with it, but again, it's saving you that amount of money. So hopefully you understand that, again, that the Think to Retire newsletter is set up to help you reduce risk, increase overall return, do it very simply, but also designed to be able to be used by anybody and save you a whole lot of money in the process. So again, thanks for watching the videos. We've got other videos in our online on our website in our video drop down. So take a look at that. Also, if you'd like to request a live demo, request a call, you can do that from our website, and we'll sit down and talk to you and answer all the questions you have. So again, thank you for listening to our video. My name is Andy Barkade. I'm the publisher and the editor of the Think to Retire newsletter. Enjoy the rest of your day.